Hello, everyone, and welcome to a market update. Today is the 15th of December, Thursday, that is, 15th of December, and hope everyone is looking forward to taking some time off for Christmas. This will be probably the penultimate market update for the year. I'm sure I'll do one next week before I sign off for the week and have holidays with the family and enjoy Christmas. Top three things today on the screen, as you can see. Got to talk about interest rates. The U.S. Fed met overnight and made an interest rate policy decision, which I'll discuss. Number two is going to be corporate earnings, something I've been talking about in these market updates, and I just want to reiterate a few things around corporate earnings, which I think are going to be very important, particularly for how we're set up in the new year, and the U.S. dollar, which many of you know I say this constantly, which is you get the direction of the dollar right, and you're going to get a lot of stuff in global macro right. So the first thing let's talk about today is the Fed funds interest rate. So the Fed met overnight, or yesterday, our time, or Wednesday, I guess, our time, and decided to put interest rates up 50 basis points. Now, generally the market was pricing in a 50 basis point rise. I had to laugh because a lot of the idiot talking heads on CNBC and other channels that I occasion when I have nothing better to do when I'm channel surfing, we're saying, oh, they could do 25 basis points and whatever. But look, the reality is that the market has been trying to talk the Fed into pivoting or to slowing the rate of interest rate increases. And I promise you, at this stage, Jerome Powell is having none of it. He is a Republican who is not happy with the fact that inflation is still running hot at over 7% in the U.S. I think I might have made some commentary in a note this week around inflation, and that the CPI came in at 7.1%. It was lower than expected of 7.1% instead of 7.3. Whoop-de-doo. There's still a 7 in front of the inflation number. Historically, when we've been running at 2 to 3% inflation, we are miles and miles away from where the Fed, and in particular Jerome Powell, wants inflation to be. So what does that mean for policy going forward? Well, the Fed funds rate right now, this is the one of the key interest rates that a lot of other interest rates are based off in the U.S., is 425 or 425 basis points, 4.25% to 4.5%. That's like sort of the target range that they're operating in. And they're saying that by the end of 2023, it's likely to be a full percent higher, or 5.25 to maybe 5.5. Now, is it going to go there? Don't know. Will it be higher or lower? Don't know. We're just going to have to wait and see what the data says. But what I can assure you is that the Fed has nowhere in any of its language suggested that it's going to pivot away from this policy action, and it has quite clearly said in no uncertain terms that it will continue to be hawkish on inflation. And this is bad. This is really bad for global markets. I'm going to explain a little bit more about that in a moment. But I want to just quickly pivot, pardon that pun, to the ECB, so the European Central Bank. Rates in Europe right now are 1.5%. That's the ECB's cash rate. Now, the ECB and inflation levels in Europe are much worse, actually, than they are in the U.S. No wonder, because when the U.S. dollar rises, everything else gets more expensive to countries like Australia, like the countries of Europe and Japan and so forth. And so they've been importing a lot of inflation, as have we, because the U.S. dollar has been strong. And as such, the ECB is going to have to probably do a 75 basis point rise. I think they meet tonight as we sleep. So it'll be interesting to see what Lagarde does. She's the chair of the ECB. Christine Lagarde, I believe is her name. And it'll be interesting to see what she says about it and what their policy response is. There's no doubt that the European economies are already in slowdown mode, and rates are going to rise there too. So we'll be on the lookout for their whatever they do. But the fact that interest rates are rising, this is such a critical thing. That's why one of the three key things in the macro, where we start with our global macro, is one of the three key things is interest rates. The second is GDP, and the third is inflation. So two key things that I talk about all the time, inflation and interest rates. And I'm going to talk about at some point, I'm sure, more about inflation. But two key things are still elevating and staying elevated. That's bad, and that's bad for the third thing, which is GDP. But I'm not really going to talk about that today. The second thing I want to talk about is corporate earnings. And I've got a chart that I want to just share with you. This was from the mid-quarter update from Hedgeyon. I'm going to try to get this large enough that you can see it, because it highlights something very important that I think everyone here that watches and listens to these updates needs to take particular heed of. And I just want to draw your attention. Hopefully you can see this. I'm going to make it as big as I can here. Earnings per share growth percent. S&P aggregate earnings per share growth. Don't worry about all the breakdown of stuff. You could scan those numbers and have a look at them at your leisure. But I want to focus on the aggregate of the S&P 500. I want to draw your attention to what happened back in 2020 with COVID. We had earnings getting absolutely pummeled. And the worst quarter was the second quarter of 2020. And then earnings began to shift. And you remember we had 6 quarters of Quad 2, and that was off the back of a lot of policy response during 2020, and eventually led to some of the best corporate earnings numbers or earnings per share growth that we saw in 2021. And again, it's why we had such a stellar year in 2021, because the comps between second quarter of 21 and second quarter of 20, that was like over 100% increase in aggregate earnings in the S&P 500. But then as the year dragged on, it began to slow, and by the early part of this year it was very clear that corporate earnings were slowing. And here we find ourselves now looking at the fourth quarter of 22, where earnings, corporate earnings, and I've been talking about corporate earnings, but they've continued to deteriorate and decelerate because rising interest rates, the U.S. consumer is completely and utterly tapped out. There's no more stimulus packages or anything like that going on. So corporate earnings are going to suffer. And we just had this huge reopening of the economy and all that stuff that happened in 2021. And so for companies to comp that, it's impossible. It's the impossible comp or comparison. So they won't be able to. They haven't been able to comp the comps. And so, but anyway, what we're seeing here is a slowing of earnings, and that's going to continue into 2023. Now, this box over here is estimates, or are estimates rather, of earnings. And as you can see, we've got only a very small 1% estimated growth. This is going to get revised, by the way. I wouldn't be surprised to see aggregate earnings in the S&P to be negative for 2 quarters, and possibly this third quarter here. We'll just have to see what happens. But nevertheless, corporate earnings are decelerating, and they are going to be negative. Now, for any of you who've been hovering around stock markets and understand companies and understand how stock prices rise, there's a couple of main things that affect that. But one of the key things that affect a stock's price or an equity's price is the earnings of that company. And if earnings in the aggregate are slowing, and I'll caveat that by saying there are going to be some sectors and industries that do a little bit better than others, and I'm not going to go into that right here. But in aggregate, earnings are going to be bad. So what's that going to do for the stock market? Well, it's going to be a drag on the stock market. It's one of the reasons that we've seen the S&P, the Dow, the Nasdaq, the Russell down, double digits this year. And there's more to come next year. And we're really going to start to see that in the first quarter of next year, which is January to March, as companies begin to report and have to guide down, saying, "Oh yeah, we didn't see this coming." Pfft, really? And the stock market's going to react. The second big drag on earnings, of course, is the fact that we're going to have an interest rate environment that's accelerating, and that's going to mean that corporates who have a lot of debt are going to have to pay more for their debt service, so they won't earn as much. They'll have to pay more in interest. They won't be able to reinvest in their businesses. And rising interest rates affect the consumer. So, discretionary spending is going to be a real problem next year because consumers, again, are tapped out. And I want to just quickly, I'm just going to close that for a second. There was an article that caught my eye this morning on the Sydney Morning Herald, which was basically saying that there is a record number of people in Australia, workers in Australia, who are holding down more than one job, so 2 jobs. or more even in some cases. And I find this very interesting, and I talked about this a few months back, probably at the quarterly update in maybe September, when there was a slide from Hedgeye, and I'm pretty sure I highlighted it, where it was talking about the fact that a lot of Americans were having to work more than one job. And the reason for that is because people can't make ends meet, because the cost of living is rising so fast. It's rising faster than wages. I mean, wage increases are maybe 2, 3, 4%, but inflation's running at 7%, and the core baskets of stuff are running at potentially even higher than that. So it's no wonder that people have to work more than one job. And I just wondered about that in Australia. I don't even know where where these statistics are tracked per se. The ABS obviously tracks them, but I'm glad to see that finally there's an acknowledgement that that this is going on in Australia. So we're not any different, in other words, than the U.S. and other parts of the world where the consumer is actually in bad shape, and people simply have to work more than one job in order to make ends meet. This is not good. This is not good. One might think this is good, but this is not good. There's a couple of other things that caught my eye, which I'll get to in a second. But just quickly, back to close off the corporate earnings stuff. Again, one of the key things that drives stock market valuations and increasing prices is earnings. So if you're not growing earnings, then you're not going to be getting nosebleed valuations. So you're going to see that continued erosion in the stock market broadly, and because of corporate earnings. So that's enough about earnings. Now, just on the U.S. dollar, as I've said before, you get the direction of the dollar right, you get a lot of things right. And the dollar has had a correction in the last couple of weeks, but it's still in a bull market. So this is a U.S. dollar, and in Quad 4, and we've got 3 Quad 4s coming over the next 3 quarters, the U.S. dollar does very well as an asset class. It's one of the few currencies that you want to own. And the reason for that is because a lot of people seek liquidity. And the U.S. market, particularly the treasury market, the debt market, and the U.S. dollar, by default because it's the world reserve currency, has that liquidity. So you'll see people going to the dollar and then buying treasuries or what have you in order to simply ensure that they're going to get their capital back. But what I would expect to see now going forward is the dollar's going to resume its bull market. And as an example, the Aussie dollar started this month, I think it's something like was early November, late October, was around the 63 cent to the dollar. It's now trading around 68. So if you're going overseas right now for the holidays, fantastic. You're going to have some great purchasing power because of the elevated Aussie dollar. But I wouldn't expect that condition to continue into next year because our central bank, the Reserve Bank of Australia, is going to eventually have to continue to raise interest rates because inflation's not going to abate. Inflation's going to continue to be a problem here in Australia, around the world. And there's going to be a lag as well, and I've probably talked about this before, but for all of you who might be new to this a weekly update stuff that I do, there's always a lag in policy changes. So it could take a good 6 to 9 months for all of these interest rate increases to work their way through the economy. The sad thing about all of this is that it's the Fed and the ECB and the RBA, they're acting too late, and they have to act with more gusto to put rates back up because they have to get control of inflation, and that's going to create other problems in the economy, which we're going to start to see those come to fruition down the track, probably in 6 to 9 months. Now, I've highlighted this in the last market update, and I'll just mention it now. One final thing to say about the U.S. dollar. Gold and some of the precious metals are definitely things that you want to own in Quad 4. And they've had a nice little run in the last couple of weeks. And I'm expecting, because of the U.S. dollar, I'm expecting the U.S. dollar to resume its strength. I expect the precious metals to have a little bit of a correction, and I will very likely be adding those precious metals and precious metal positions to your accounts. So you can be on the lookout for that. Because those, again, are a Quad 4 asset that we want to own. Now, what was I saying? Yes, I wanted just to quickly hit on something that is coming up in June. I've been talking about this, and it is all these mortgage resets. So one of the questions that will be unanswered, but will be answered towards the middle of 2023, is what happens when all of these fixed rate mortgages that were taken out during the COVID pandemic response, where people were getting 1.99 and 2.19 and these really low 2% fixed rate mortgages for say 2 and 3 years, they're all going to start to reset as of next year, and even in June is one of the big months for that reset. What's going to happen? Like all of a sudden, people's mortgages, and some of you may be in that camp, are going to go up by 30, 40, 50%. Now, I dare say that could create a very big problem for the housing market, because all of a sudden houses which are already unaffordable, and I just dropped this article because this came in today through another channel, this thing that I get articles on, owner-occupied loans plummet as housing affordability declines. Well, housing affordability has been declining because interest rates have been rising, but we're going to have to see a correction in the market in terms of house prices to deal with this situation. So the market will work itself out, as it always does. And higher interest rates will mean lower property prices. Will the market crash? I doubt it. Will it go down by 10%, 20%? I don't know how much it will go down. It'll go down as far as it has to go down in order to find some sort of equilibrium. But it's not going to be appreciating. I suppose that's the key message here, is that housing as an asset class is not going to be going up. And I'm sure there'll be some isolated situation that you could probably find, or the eastern suburbs, somewhere like Vaucluse or Point Piper or something like that. Like 1% of Australian housing will maybe go up, but 99% of it is going to go down because it's a function of interest rates. And so, I know I've been talking with some of you over the last few months about buying properties and this sort of thing, and I've tried to dissuade you from doing that because of this, because interest rates, the price of money, is so important, and the price of money should drive a lot of your investment decisions, and particularly in assets that you have to leverage. So if you're leveraging property and the cost of money is going up, it's likely that the cost of money is going to rise faster than your ability to increase your rent. Just rewind that and listen to that statement again. I'll say it actually just for your benefit. The cost of money, the price of money, usually rises faster than your ability as a landlord to increase your rent. And that's a problem, because it means that the cost of you holding that asset rises faster than your ability to recover those costs from your tenants. So that's going to be a problem, I think, for a lot of landlords, for a lot of other potential people who own property out there. And I don't know what's going to happen. I could make some guesses on what might happen, but nevertheless, it'll be wait and see. So that's going to be an interesting thing to look at. Now, because I want to try to keep this under 20 minutes, I just thought I'd hit one other thing. I'm reading a book right now. I put it down, but I picked it back up, which is called Economics in One Lesson. This is Henry Hazlitt, who's basically an Austrian economist and a big believer in the Austrian School of Economics. It's a really good book, and it actually talks a lot about the various things that Keynesians and other economists get wrong. And one of the chapters I'm reading actually at the moment, or have read in the last couple of days, has to do with government price fixing and government intervention into markets. And I couldn't help but have a read of this article today, where the government, without consultation to industry, has put in an energy price cap bill, presumably to win, to pacify the Greens. But this is going to be a problem for Australia. One of the things that this does is it tells energy companies that Australia may not be a country that you want to invest in, because the government can just go and do stuff and disrupt your business models. So this is going to be a problem. And if these Muppets, and I'm going to call them Muppets, but honestly, if they think that going back to coal is better, I mean, look at the smirk on this idiot's face, right? If they think that going back to coal is a better idea than burning natural gas, gas is cleaner than coal by a long shot. But if they think that's a good idea, they need to get their head read. And if they think somehow that we're going to create, a completely fossil fuel free economy in Australia, and situation in Australia, they need to have their heads read. I've just watched an update from the industrial analyst at Hedgeye talking about lithium and rare earth metals. And the fact of the matter is, I'm not going to go into it right here, but the fact of the matter is, we don't have enough lithium supply right now to supply the EVs, electric vehicles, and other electrification. Battery storage of things that they want to do, and it's going to take years for that production to come online. Not to mention the fact, and I think this is the hypocrisy, the absolute hypocrisy of the whole thing. Not to mention the fact that to mine lithium and to mine these metals and things like that is detrimental to the environment. So it's just so stupid. I just can't even believe it. So basically, I guess what I'm saying here with this is you should be pissed off about it as a consumer because it's going to cause the price of energy to rise in Australia. Power bills are going to get more expensive, and people are going to be, I don't understand why this is happening. Well, this is why right here, because these smirking morons are making a huge policy mistake right now. And I don't care whether you're Labor or Liberal. If the Liberals did this, I'd be lambasting them just as hard because it's such a bad policy. Anyway, enough on that. And this is one of the outtakes, right, is that these gas projects and other things, which, by the way, are being invested in, creating jobs and will create tax revenue and everything else, and energy security for Australia, might be shelved. Horrendous. Can't say anything more about it than that. Let's just do a quick run around a couple of key metrics that we look at. Volatility has been interesting the last couple of weeks. We've had the VIX up as high in the last couple of days as, there we go, 26 or so, 25 and a bit. It's come right back. That's going to very likely elevate again. We're in the chop bucket, which is I talk about the investable bucket, which is VIX sub 18. That's the VIX sub 18. The F bucket, which is VIX 29 plus, 30 plus, and the chop bucket, which is just where markets are just up, down, up, down, up, down. And we're in that chop bucket. We're at the low end of the chop bucket, but we're in that chop bucket. The VIX-N, which is the NASDAQ vol, popped up to around 30, almost, or tipped barely into the F bucket. Probably will get back there. And Russell vol is also going to be headed back higher. Anyway, that's about it for today. Hopefully you'll have a good Christmas break, and actually, like I said, I'll have one more, I think, market update before it's all said and done. If you have any questions about anything I've said, please let me know. And with that, I will say have a fantastic rest of the week, and talk to you next week before Christmas. Cheers, everybody.